Hello and welcome to our discussion on the preparation of financial statements. Here we'll try to understand the putting the business decisions or financial transactions into financial statements. And for this purpose we are taking a set of transactions of a group of friends who started a firm to trade in shares and paintings. The members contributed 600,000 as the capital. Let us see the effect of that on the financial statement. So capital is a source and they received 600,000. So it is a receipt and a source. That was the first transaction of this firm. They contacted a local bank and convinced the manager to give a loan of 300,000 at the rate of 4% interest. At the rate of 4% interest, they took a loan. So loan is a receipt and they got 300,000 and loan is a source and a liability. Loan is a source and a liability. So we see that both are receipts and they are the sources, not incomes yet. For the time being, let us assume that the business has been started on 1st January. So our accounting year is January to December, because that is required to calculate the interest or any other statutory payment for the period 1st January to 31st December. To an calendar year is the accounting year in this case. For example, in this case they have taken loan on 1st April. So for this year they have to pay interest for 9 months only. Let us see the next transaction. At the end of the year, they declared dividend, 30% profit as cash dividend. But we'll use it only when we find the profit after determination of the profit. The transactions which are investment and operating undertaken by the firm are as follows. They use the money raised through capital to buy the shares of XY Limited, 10,000 shares of XY Limited, so 200 at the rate of 25 per share. So they purchased shares. They purchased shares of 250,000. And share is an asset. Share is an asset. And the payment to that extent has been made. Acquisition of asset has resulted in cash outflow. Use the balance money to buy 20 pieces of old paintings. What is this balance money? They raised 900,000 by now, the capital and loan. They used 250,000 to buy the shares, so the balance is 650,000, and they purchased paintings for that with the balance money. They purchased paintings, and paintings is acquisition of asset, resulting once again on the outflow of cash. Received 20,000 dividend from XY Limited. Because they have shares of XY Limited, they received 20,000 dividend, and that is an income for the company, and they received that dividend, so it is an income and a receipt. Sold 20% of the paintings for 400,000. So they sold 20% of the paintings for, so the cost of the paintings sold is 20%. So 130,000 worth of paintings were sold for, they sold it for 400,000, for 400,000, and that is for cash. So an income received. So the paintings, as a result, the paintings will reduce to the extent of the number of paintings which have been sold. So the value of the paintings on the balance sheet will reduce. Operating expenses during this period, they paid 20% of the sales of the expenses. 20% of the sales has been paid as is treated as an expense. So we'll treat 20% of the sales, 0.20. Did they pay that money? They paid only 50% of these expenses during the period, but because of the accrual concept, we record the entire operating expense, but the payment that we'll make is 50% of this. So an expense not paid is a liability. An expense paid is an outflow of cash. An expense not paid is a liability. Now they have transactions, all transactions are done. But since they've taken loan, they have to pay interest on that, and interest for the 9 months only. So rate of interest will be, they've taken a loan, the loan was at the rate of 4%, and they took the loan on 1st April. So interest will be calculated on this loan amount at the rate of 0.044%, but they have taken the loan on 1st April, so therefore interest for the period, as per the matching principle, they have to charge it for 9 months only. So interest for 9 months is 9,000, and let us assume that they pay the interest. So all the transactions, all the decisions that they have taken, all decisions they took have been transferred to the financial statement. Money contributed, loan taken, interest on the loan, will come to the dividend at the end. They use the money to buy shares, they use the money to buy paintings, they received dividend, they sold paintings, and they paid expenses. Now once you have all transactions have been entered, we'll determine the profit, and profit is income minus expenses. So we'll call this as PBT. Okay, we'll call this as profit before tax, and the profit before tax in this case is income minus expenses, and let us assume the tax to be 30%. Let us assume the tax to be 30%. So therefore tax, and let us assume that we are calculating tax on the profit before tax, and pay the tax too. It's a payment, a statutory obligation. So PBT minus tax is PAT. If no information is given, we will not distribute PAT, but we retain the entire profit on the balance sheet. So it is a retention of profit. So profit becomes retained profit, and it becomes a source. We can find the cash in hand now. Cash in hand is equal to cash available minus the cash payment. Cash available minus the cash payment. So cash in hand is 310, and cash is an asset, and cash will go to the balance sheet. If all transactions have been done, we know that the sources should be equal to the applications or assets. The sources are equal to the assets. So by the end of the period, the business had total assets of 1.08 million, supported by an equity of capital and the retained profit, and liabilities are loan and the operating expense payable. So in the process, the group of friends which contributed a capital of 600,000 have earned a profit of 140,000 by the end of the year, and they created an asset of 1.08 million and supported by equity and liabilities. Thank you very much.